Oh,
Hey,
hello
hey,
there.
hey.
We're live, and I instantly realized that I forgot to do a thing with the phone that I want to do because that's what we do. Uh, Dang it, and now you closed the app. Okay. Anyway, hi. Welcome.
This is a great start. Well done. This is
worst intro to a live show ever.
professionalism absolutely on point, like
Yeah,
nailing it. Yeah.
yeah. I tried as hard as I could, almost. No. So, let's see. Okay, so anyway, welcome back, guys. Whoever's still here, we said that we might do
Everybody's
it.
just tuned in and gone, who are these idiots, and gone
Yeah, exactly.
out.
No, but we were saying that we would try to do this yesterday, but things got in the way, so we decided let's do it today, which is actually not a bad idea because today the producer price report came out as well, and we were not late, Golden Goose. I clicked it on the second, so. He likes to complain. I'll let him complain. Just let him. Yeah. So we actually added. We were only supposed to be talking about the CPI and the core CPI today, or yesterday. But then we skipped yesterday, and now we're doing this. So we got the PPI as well because that came out too. So this might be a little bit longer than we would anticipate from the start, but that's a-okay.
That's fine. That is fine.
It's fine. It's fine. And something that's not fine though is that the website that I'm using to look at these metrics does not have dark mode, and it is very, very bright. So I apologize in advance. But
Phil looks like an alien.
Yeah, I look like a ghost.
just like Mr. in The Simpsons, Mr. Burns when he is all drugged up and he comes out. That's what Phil's going for.
Yeah, it's a good look. It's a solid look. Anyway, let's dig into this right away so we don't just sit here and talk crap all day. Let's see.
That's
here
all
we go.
We do.
I know that's what we do, but we can pretend like we don't.
Yeah.
For a couple of minutes. All right. So CPI came out. I think this surprised me actually because I was expecting that it would be what the forecast was, what the expectations were. So the expectation were 5.2, and then it was actually revised down like just a couple of hours ahead of time to 5.1. But it actually dropped down to 5. And this
Why?
was yesterday.
What's the point in revising something that you know
Yeah,
is going to come in under anyway?
I don't know. I don't know. But
it's
either way,
it's a totally legit metric though, right?
Yeah. Well, so either way, it came down more than expected, which is it actually came down from 6% all the way down to 5%, which is actually quite a significant drop. You can see the big chunk that just disappears here. But like
I wonder
the trend is what it is, right? So we're happy.
Yeah, I wonder if any sharp-witted individuals called this a few months ago.
Yeah, I think there was some guys on YouTube. I can't remember the names. They were wearing glasses all the time.
I have not got
like
mine
weird
on.
colored. I know that was a hint to put yours on. So I don't want to look like a nerd on my own.
You always look like a nerd, so it's fine.
I know, but I am a nerd, so that's fine. Nerds are the greatest. Either way, so we're down to 5% on the CPI. So energy, for example, fell from 6 point. It fell with minus 6.4%, which is a lot, and namely from those, as it states here, was 17.4% in gasoline prices, which is pretty significant.
And 14% oil, yeah,
and 14% oil. So that's the big one. But then we also have actually food. Was still growing, but it's growing at a slower rate. So last month in February, it like food inflation grew by 9.5%, but this month it only grew by, March it only grew by 8.5. So that's a whole percent down as well in the speed of which it grows. Yeah. So again, I was watching some other people.
Rate of change is important, and this is to see an acceleration down. This is that what we were saying in that I would say a lot of the sources of inflation came around January, February, March last year. That was when a lot of stuff really started to explode and a lot of things peaked in price between this April to July period. So over the next few months, we are going to see prices on a year-over-year basis significantly negative, and that'll push down hard on this metric.
Yeah, and something that I wanna emphasize here is that I believe that this is the first time, like when they started rating hikes, they were rating hikes. Hiking rates. Wow. No, but they were raising the rates by 75 basis points, which is 0.75%, right? And this is the first time that we're actually dropping the rate faster than it ever grew, which is, I believe it was because this was a smaller one, yeah. And that's a good sign. But it's also like, I wonder what next month is going to do, because we were peaking like 2 or 3 months from now, we were peaking, right? So 3 months from now, we were peaking in inflation. And if like it can go down very fast, it can even go deflationary, maybe. Which, I mean, if it's short term, wouldn't be horrible, but yeah, everything is lagging, right?
Yeah,
but
and this is the thing with the inflation rates. They are lagging. The inflation hikes, yes, because they are lagging, this trend of this downward pressure of inflation is going to continue, and it's going to continue to increase in severity. It's not going to drop. Even if they pause, there is pain to come down the road, and that's now unavoidable.
Yeah, and that's kind of crazy, because the goal is another 3%. So let's say it goes down by 1% for 3 months until it peaks, and then they're like, okay, now we're gonna pause. But the thing is, inflation is still going to carry on going down from there, because, I mean, look at this here. This is what we're trying to, like. Yeah, it's
good analysis.
It's not going to be what I'm trying to say is that even if they pause now, inflation is still going to carry on going down because of the lagging effect of the rate hikes.
Yes.
And if they wait for 2% or 3% before they even pause, then
they've overshot.
By a large margin,
by a long way. They held for way too long. They rose way too quickly, and now they're rising when they should be dropping. And it was I don't know how many months ago it was. It was like, this is the trajectory. There's nothing that can really be done except now is to plan for the results and see what's coming as a result of this, because what we've seen, the sticky side of inflation, if we look at core inflation coming in slightly higher.
Here, you're actually bringing this up too.
Does it have so does that have the makeup of the metric on this page? I think it does, doesn't it?
Don't think it does. No.
It's a shame.
Well, that's all right.
Does it say no?
I don't think we have to dig in too deep.
It's more, say, if you look at, say, things like housing, and rents, which have been stubbornly sticky. When everything else has been coming down, these have been staying flatlining, or in some cases carrying on going up. Now, the inflation rate has a huge impact on mortgage eligibility, has a huge impact on the amount of money which can be borrowed to support the housing market at these rates. And it's highly likely across many countries in the world that we start to see a housing market sort of at the very least cool down or flatline, and at worst a big old drop in the same sort of vein, in that housing, the real estate market is collateral in the same way that bonds are collateral, in the same way that say all of these assets that we've seen have problems with liquidity when things like banks go under, and housing, real estate is a big part of that. And if that starts to drop, and that can be affected by banking crises, by run on the banks, and the fact that people can't borrow money to get the mortgages at the price people are asking, then that metric can very, very quickly collapse. And I'd say on a year-over-year basis, that's something that is sticky, it's lagging, that's not really shown the drop, and it's still that's contributing now a lot to this inflation. And when that starts to flatline, again, we'll see this another drop in this inflation rate. And the downside of this drop can be pretty severe because, yeah, this causes collateral problems in an already stressed system that's still full of the same tricks and foibles and bullshit that it was in 2008. Not to the same extent, maybe, but still there. And it's the same mechanisms exist for a lot of fuckery, should we say?
Yeah, yeah. Well, it's you know, the core CPI, it excludes food and energy, all the the volatile stuff, right? And this has actually increased since last month. So we have a trend reversal. It's not. It doesn't mean that it's gonna go up again next month, but obviously the market would have preferred to see 5.4 or 5.3 or whatever. But the consensus was actually, and the forecast was 5.5, and the consensus was 5.6. But it did actually go up by 0.1, which is not massive, but it's not great. And that's one of the reasons I think that the market actually didn't do that much. I'm just going to do this real quick. So yesterday, when it dropped, we actually had a red day. Even though inflation was down, inflation rate was down, everything was down, but then the CPI was probably one of the factors that kind of gave the markets kind of a neutral standpoint a little bit, because it was going up. I was watching the I can go to the 1 hour and you should probably be able to see it here. This is the classic CPI drop look of the charts. So it started by going up, and then it just started falling down, and then kind of flatlined into the same area again. It's one of the reasons I think is the CPI, the core CPI was actually up. But then today we got the producer price inflation, which had a massive drop. The forecast was that it would actually go up by 0.1, and consensus, which is I guess the consensus is just what the overall polls would say from retail or whatever, or what the average was or whatever. But it went down by 0.5%, which is a huge drop. It hasn't done that type of drop in, I can't even remember. I remember looking at this, and I can't remember it now, but it hasn't done one of these drops since 2020, something like that.
Yeah. Well, 2020 was a big drop. I think I think if you press 5 the 5 year, you can see.
Yeah, I think
So yeah, we have had worse, but this is what the effect of demand destruction is. This is demand destruction straight here.
Yeah.
The amount of the prices commanded for the goods that are sold are reducing.
Yep.
That is a contributor to deflation. It's it means that either a combination of the labor that goes into it, the commodities that goes into it, the amount of energy that goes into it, all of those things are not going up in price as things currently stand, and the market is not able to maintain these higher prices because there's a reduction in people who can afford them, and
yep.
This is a downward pressure, but this is a result of downward pressure from the situation we've been put in, and it's here to read, and this isn't any voodoo or magic ability to read these charts. I mean, they put them out every month. You can look at what they are and why they exist, and yeah, what they're saying and what these numbers are saying are not the same thing.
Yeah. No, and by the way, it said right here at the start. This is probably where I saw it. Since April, it hasn't done a decline like that since April. But yeah, so this reaction, the market actually reacted more positively to this than to the CPI and all that. So maybe the market was just waiting for the PPI instead, rather the CPI, because the CPI is kind of redundant at this point. People already know what the trend is. We've been in the downtrend on CPI since July, I guess you could say. And from there it's been decline of various sizes, I suppose, but
a decline of various sizes.
Yeah, well, yes.
Is that what you're going with?
Dude, I'm Swedish. Hey, can you say that in Swedish for me, please?
It's a decline of various sizes.
Why do you sound like a German guy? That's so horrible. Either way, yeah.
I was doing my best Phil doing an impression of a Swedish guy impression.
Yeah, okay.
Because you can't do it either because you sound English or not Swedish.
I sound like a drunk Canadian or something. That's what I've heard. Anyway, yes.
Yes.
Yeah, I think that's why the market is not really reacting to the CPI, but they did react to the big change in the PPI.
Yeah, and this kind of the thing to sort of consider here is that what's the narrative? Like, the narrative is pretty played out in this, in the same way that we saw the inflation narrative play out when inflation peaked at topped at what's it say, November was it? Oh, sorry, it peaked at, did it say? Could we just go back
CPI?
to
Oh no,
CPI, yeah.
June.
Oh, sorry. I'm sorry. I'm more thinking when it started to drop. Okay, it was early, wasn't it? It was September when it really started to drop from 8.2. That's 7 to 7.7. Yeah. But the markets have bottomed a couple of months sort of before that, and really started to meander sideways. Like the inflation narrative has been played out since mostly at the beginning of last year.
Yep.
And the market stopped reacting to the fact that inflation numbers, this one came in hot and this one came in whatever. Like, everyone knew, inflation's high, it's not going to stay that high. And now inflation's reducing. Everyone knows it's going to reduce, and it's going to carry on reducing. And
there's no one is nervous anymore. Since the trend has been down for so long, there's no like, oh crap, what if it goes up? What if it starts going up? What if it goes up more? There's none of that.
Well, it's in terms of the changes of differing sizes. What you want to look at is sort of the deceleration and acceleration of these metrics. You want to see the amount dropping reduce. You want to see it sort of flatline before it reverses. Right now, this is an acceleration downwards. This is a feature of the fact that it's a year-over-year metric. It's going to accelerate quickly downwards for probably the next 3 or 4 months, or maybe 2 months. The next 2 metrics will probably be quite far down, and then it will begin to flatline, and we'll see where it flatlines, and then it's gonna, and we'll see where the next.
I think June, where the peak is, I think that will be the last time where there's like a significant drop. And then from there, hopefully it flatlines rather than starts going up again, because that would be horrible. The question is if it's gonna, if the target is 2%, I think still, I don't think they've changed their target to 3. But
they haven't changed the arbitrary value in which they're trying to get to.
No. So the question is, will it flatline in between there somewhere, or will it flatline below 2? So I'm leaning towards below 2, to be quite honest with you.
I've been calling it for a while. I think
it's
going to bottom close to 0.
Yeah, we've talked about this like extensively in private, me and you, with other people in the Discord, by the way, and we most of the things that we say here are things that we have already talked about a while back, and just seeing this play out. I'm not gonna lie, it's pretty. What do you call it? It's pretty satisfying to be like, we knew it. We already knew this. Yeah, not saying we're always right, but this is not something that's very difficult to figure out. Just looking back in history at other events like this is it's the same thing happens every time because they do the same thing.
Or can you if you just click max on that chart and see, let's see how far we go back, and we can see the peaks every time. Yeah, and every single time you have a rapid acceleration upwards, you have a rapid acceleration downwards, and the suggestion that we're in the 1970s, that people had claimed, it's the Volcker era and things like is like, no, it's not, because we've got a very different demographic profile and a very different debt profile. We're in the 1940s. That is the setup that we're currently in. And look what happened in the 1940s. You have these periods of low inflation, spikes up, spikes down, continuous chop within that market, and that is the economic setup that we have. We have a lot of uncertainty, huge supply chain disruption, a huge debt burden of many countries, failures of infrastructure, food supplies, water insecurity. Like, this is this is not a good decade. We did a video very right at the start. Everything is bad. Everything is still bad, and it's going to get worse, unfortunately. So this is it. This, like, to me, it's written in our future that we're going to have these choppy, nasty, horrible bits of inflation. Not as severe as we had maybe in the 1940s, because we have much more precise methods of fixing it, manipulating it. We are a lot
data
more...
is easier to come across as well. Like, the way that they collect data is a lot more accurate, I think, as well.
Although that same data has been telling them that they should have been cutting rates for the last few months.
But they're funny people. So and that was me trying to be a bit
funny
nice.
People.
No, you're right. I mean, could you imagine if we go into like we did back in like the 30s here, going to minus 10%, 10% deflation and this is like for years, dude.
Well, that was Great Depression, wasn't it? So and that's, you could put that's another kind of look. And we just had the Roaring '20s, and we're now heading into a Great Depression before we've even maybe. Is the war still 10 years off? Is that it? Are we 10 years from World War III?
I don't know, but
I think it ain't good. It ain't good.
Let's jump on the next piece here. This is the jobless claims, and this came out today as well, alongside the PPI, and we had a forecast of 228K of jobless claims, which basically, but it was actually more. It's a number, exactly, but we actually got a lot more than that, and this is something that would suggest that unemployment is going up, which is something that the Fed is trying to work towards, because one of their jobs is to make sure that you lose your job, basically, at this point. But the numbers that came out in March for 2023 actually dropped it from 3.6% unemployment rate to 3.5%, and they wanted, I think they're aiming for, somebody correct me if I'm wrong here, but I do believe that they are aiming for 4.5%. Basically what they're doing, their plan is basically this, and this is gonna be a really rough outline. Okay, inflation rate down to 2%, unemployment rate up to 4.5%, and not doing any interest rate, not lowering the interest rates until 2024. So their best case scenario in 2023 is that they're eventually going to say, oh, we're going to pause here, and then they're going to hold the line flat until as earliest in January 2024. And that's they're not going to do that. I'm just going to say that straight up.
They're going to hold rates flat until something breaks.
Well, things are breaking already. Let's be honest.
Yeah, but that's to say until something. When I say when something breaks, I mean that you look at the Silvergate, the Silicon Valley Bank. So that was a $200 billion bailout.
Yeah,
that was a domino start to fall, and they went, oh, let's just stop it.
Yeah,
but there's still the knock-on effect of that. There's still other dominoes all around it. The same thing that knocked over that one domino is coming for the others, and eventually there's going to be a reckoning. There has to be some sort of moment when the system falls off. There's no buyers for the sellers. There's no liquidity available. There's just a complete barren wasteland where all of the assets that people rely on to back up all of our entire monetary system suddenly have nobody available to buy them. And that is a scary concept that unfortunately is a very, very it's a real potential reality. It happened in the COVID crash. It happened to the UK in September because the Liz Truss made a £40 billion budget, and it cost her job and 65 billion in QE to fix.
Good job.
40 something days. But essentially that was it. It cost 65 billion to correct a statement that they were going to try and borrow 40. That's how that, like, there was nobody in the market willing to say, like, you're taking my buy side liquidity. If you're going to issue 40 billion of debt, I don't want to be in this market because I don't want all of that pressure adding onto my position. I'm out.
Yeah.
And there was, and everybody else thought exactly the same thing. And if you're a large bank, if you're a central bank, or if you're a big commercial bank, and you hear that statement, you're going to go, what do I want right now? Do I want British gilts, or do I want German bunds, or do I want US treasuries, or do I want Japanese bonds? Like, at that point, there's so many other options than holding something that you know is going to reduce in value. Yeah. And when that happens across the board, boom, we get a COVID crash. We get we've seen it. It happened, and the COVID crash was built in before it happened. It wasn't because of COVID that it happened. COVID was just the catalyst. The systemic failure and the stress was already built into the system.
Yeah. There's something that I wanted to mention now that we're on. Talking about Europe-ish, Eurozone. So I do have the report here from Euro indicators, and this is the inflation from. I want to share this. I just wanted to highlight this. Annual inflation is down to 6.9% from 8.5%.
Wow. So
that's 1.6% just in the Eurozone.
And that is energy. Almost certainly, yeah? That's got to be a huge component. Has
most
to be
definitely. From coming from me, who's living here in Sweden, in December, our 1 day of this house, this, like, just having the lights on and the TV upstairs and this computer for a couple of hours every day, it cost us, I believe it was like somewhere between $20 and $40 a day in electricity.
Good value
in Sweden. And Sweden got it really bad, because in Sweden they actually beforehand they started shutting down nuclear power plants for ridiculous reasons that I'm not going to talk about. But then what also happened at the same time as the winter started, they were like, oh, actually, one of the 3 nuclear plants that we do have, we're going to take that offline and do service on it during the winter, when everyone is like, excuse you? So it got very bad. So what happened is we got super high inflation on, it went from like 4 cents a kilowatt hour all the way up to $1 per kilowatt hour. I think it was just over $1 in Sweden, at least in my area. Just overnight, literally, when December came in. And from there, it's gone back to normal, almost normal. It's still more expensive than it used to be, but it's gone back.
It's gone back to the new normal. It's gone to the new normal.
Well, it's come down. It's come down from $1 to like 8 cents. So it's still twice as expensive as it used to be. But it's still like, now it's manageable. It's not horrible.
I mean,
but
8 cents. You can almost mine Bitcoin with that.
I don't remember what the
China, I believe, so a lot of the China sort of marginal cost was down at around 5 cents. So at 8 currently, that's probably profitable.
Yeah.
Well,
first I need to buy an ASIC if I want to do that.
It is financially viable, even including the cost of the ASIC. So
yeah, I know. I just no.
I mean, I'm still paying an absolute fortune, like way higher than that. Probably, I don't even know, 25, 30p a kilowatt hour.
Yeah.
So
it's crazy. But yeah, so I just wanted to mention that now that we were kind of touching on some UK stuff and Eurozone stuff. So at least in Europe, it seems like I feel like this month is a good month overall, because today we also had the ETH hard forks. Was it Capella and something else? They call it Chapella.
I can't remember the name. It is.
They call it Chapella. Now you can unstake your ETH and you can do whatever. And people thought that would be a big dumpage, but actually ETH, and I can show the rest of the market just super quickly. Basically everything is green.
Everything is green. Yeah.
ETH is up 5%. And so that's good. It seems to be going good. Everything is up. Solana's up almost 4%. Cardano even is up 4%. Bitcoin 2%. So it's been a good day today. I think it has to do with a lot of the market was probably scared about the whole ETH thing, because if ETH does a massive dump and drops a lot of, if ETH goes down 10%, things will follow. It has some effect on the market. It's not like if Bitcoin goes down, everything goes down, obviously. But I think ETH can do that too. If Solana were to break down, none of the others would give a crap.
No. No. Yes. Solana BNB. Yeah, Solana BNB could maybe, they could have an impact, but not a significant one.
Yeah. Yes. True.
There's just not enough market liquidity to move them. I mean, you can see. Look at Bitcoin, ETH, and take Tether and USDC as well, and there's not a whole lot left when you take them off.
Yeah.
So the vast majority of the market is these two, and we saw yesterday. We had a bit of a look, and on the Bitcoin chart, versus Bitcoin, pretty much every single alt was red. Like Bitcoin broke out, and the BTC charts bled. And what we've seen today is now we're seeing a lot of this money rolling into ETH. And if you look at the Bitcoin charts, a lot of things are up against Bitcoin, but they're down against ETH. And so you're starting to see this rotation of Bitcoin into ETH, into alts, that happens during these pumps. And it's a nice little feature.
I'll say this though, just to give some perspective. I don't know how much people can see here, but this is on Pionex. So Bitcoin has so far today has traded with $341 million, ETH $290 million, and then the second highest that you can get here is 16 million, which is Blur, and then it drops down to Doge is 2.5 million. I mean, Solana $583,000. That's the difference in liquidity or at least interest.
Yeah.
And you can see it, by the way, Arbitrum is trading with, and Blur too has gone up 15 and 11% with the ETH pump, I think, because they're both ETH projects, ETH-related projects. But yes, so that's that. Golden Cool says EU Pionex. Pionex is good for what it is. I use it. Rob even uses it. I think. Do you still use it?
I've got an account. There's nothing in it.
Okay. Yeah, I know you were using it for like the arbitrage bot or something like that.
Yeah, the thing is that you can use it on Binance. The same
yeah,
bots,
that's true.
So I use true. Binance.
Yeah. Either way, there's potentially another platform coming out soon that will be a lot better than Pionex, and we'll talk about that later. We have inside information.
Inside information. I mean, we might as well, because this is he's the only person watching.
Only one talking, at least.
Yeah.
But yes, so I think pretty happy with where we are right now. So we can probably run this off, and we'll see what happens. I think the last thing we can go over just super quickly before we end this. With all these numbers coming out now, what do we think? Are we going to see a pause on May the 3rd? I say yes.
I honestly don't know. I can't really. To me, you say this is obvious now that we're at this crossover month where if they hold, well, the inflation rate is going to. The inflation rate is going to bottom, and then it's going to come up and normalize. Now, I would assume that they are thinking, even if it bottoms, say it goes down to 1 or 2%, then they're thinking we're going to hold rates anyway at, say, 4, because we think it's going to normalize back to 4. So we're not going to reverse course and lower rates. We're going to wait and hold the course, and we will suffer through whatever pain comes as a result of the rate hikes and the damage that's caused. That's the brave thing to do, and that really does depend. It's like the amount of damage that could be caused by them holding rates here and allowing things to just play out could be huge. On the other hand, we have we have to accept there are forces within the economy, within the things aren't 100% bad, and as much as we like to say that, we have been seeming to come across that they are, we have still got this labor shortage. What a labor shortage generally means is there's a lot of room for people to actually all of those efficiencies that come around during recessionary periods, all of that wasted, those companies that aren't going to make it, that aren't going to survive, that creative destruction, you do get to see that. And so if you can have this sort of transfer and this increase of less profitable to more profitable companies, where the winners in the hard times are the ones that win, that's kind of the I hate to say it, but that's the laissez-faire capitalist sort of view of the business cycle, is that it takes care of itself. And of course, it is, to an extent, it is correct. You have to accept there's going to be damage in the process of that downturn, and the laissez-faire capitalists would say, let it be, and the market will be what it is. And everyone else says, you absolute sociopath, like, people are suffering and we can do something about it. And that's kind of that's the trade-off, and that's the state that we may end up in.
I'll say this: the reason to why I think that they will. I mean, the reason to why I say they will pause is, with all these numbers coming out, it's a big difference to what it was the last report, and I don't think they're going to lower rates, because Jerome has been very. He's every time someone is asked, he said, "No, we're gonna keep either racing, or if we pause, we're gonna hold until the end of the year." And he's always said that, and he's been pretty good at saying what they will do and then do it. consistently so far. So I suppose we could see a pause, and then they will just hold it. And that's my personal prediction is pause, and then if things go really bad, then they will lower things. But
the really bad is still to come further down the line.
Oh yeah,
you're talking 6
summer
to 9
is going to
months
be
down the line.
the summer is going to be the start of it, maybe, where it's like, oops.
And so how long are they going to hold? Because if they're looking to hold for 6, 12, 18 months, then that means that they're happy to sit and hold rates high at a point when the markets are going to be screaming for them to go lower. That is a ballsy move.
Yep. I think the argument that Jerome has is that they don't want to go back to the Volcker times where it's where you had a big dump in inflation, then it came right back up again.
Yeah, but then often that happens. That's the reason that happens is structural. It's because of the fact that it's holding a beach ball underwater, and the longer you hold it underwater for, or the deeper you hold it for, when you let it go, the higher it flies up in the air. Like there is a reaction for every action, and what we're seeing now is a huge demand destruction, a huge level of demand destruction, which is pushing this inflation rate lower. They're almost certainly going to overshoot. Then they have to. Then they are going to be forced in some way to offer some sort of support, financial support, whether it's monetary or fiscal spending, some sort of action, which will then about turn and is then adding inflationary pressure again. So you can't, you can just let it be, but even if you just let it be, you can get this sort of contraction and expansion of just that takes years and multiple cycles sort of to solve. The reason we have this need the demand destruction now was because of the excess demand created as a result of the lockdowns, which was a huge amount of incredibly fast demand destruction. That demand still existed. It didn't disappear. People still needed shit. It's just it wasn't getting made. So then when everything opened back up, all those people that hadn't got the shit that they need went and got the shit that they need. That meant that more shit got made. And now everybody's bought the shit that they made, and all the prices have gone up because everybody needed the shit now. There's no one left.
A lot of shit.
But yeah, there's no one that's got any money to buy the shit, and all of the shit is expensive.
Yeah.
And now the shit has to hit the fan in order for everything to get spread out the way it should be, and we can get back to normal after we've cleaned up the shit.
I think I'm going to get you a t-shirt that says shit.
Thank you for coming to my TED Talk. That's a lot of shit. That's a lot of shit.
That's a big truckload of shit.
That is definitely a lot of shit.
So with that shit, I think it's time to end it.
That's a good end. That's a good way to end. We'll end it on some shit. Yeah.
Yeah. So thanks everybody for joining this shit, and we'll see you in the next video, I guess, which is going to be on Saturday. And remember to hit the shit button. I mean, subscribe button. Hit the
shit button's next to it. That's a dislike one. Don't hit that one.
Yeah, don't hit that one. That's the wrong one. Hit the thumbs up one. The thumbs up. The subscribe if you haven't subscribed yet, and join the Discord. We're gonna jump in the Discord after this and hang out for a while, and maybe do some face-to-face talks with everybody, and see if we can listen to some thoughts and what you guys think might happen here. And yeah, I'm just excited for May 3rd, to be honest, because I really want to see what happens. My vote is on pause, but I might be wrong. So we'll see. But yeah, thanks. Bye.
Bye.